Welcome all. I'm Hemant, the founder and CEO of iNRI. Happy and super excited to be hosting this webinar today on a topic which is, I think, very valuable. I feel, especially for US NRIs. A lot of us find this very confusing or maybe also complicated. Trying to invest in India, but then there's a challenge with moving from dollars to INR. Then you need to invest, you need to identify the right investments, and then once you need to liquidate and get that money back, it's kind of also again painful at the same time. And I think a easy way to, kind of navigate this would be directly investing in dollars if there is one. There are obviously ETFs available on Nasdaq and one could do so, but there is a limited variety there, right? You can only invest in index funds that track the Nifty 50 or maybe a very limited handful of those funds. So what if there is a way to, take exposure in small mid-cap companies or maybe a select group of companies where you have a professional fund manager managing this. And I think this is the exact topic that we're going to discuss today. And I'm really excited to be hosting Saurabh and Nitin from Compounding Gems. We will also be talking about their fund, but more importantly, how the structure works like, and why this is exciting and interesting for customers and investors today. We will be sharing the recording the webinar and sharing that on YouTube. So stay tuned for that too. And I just want to introduce Saurabh and Nitin. So Saurabh and Nitin both, know each other for a long time. They've been in the market of investments and finance for more than 20 years both. They both are IIT and IIM graduates, and I personally know Saurabh for more than 2 years now. Um, and so I'm really excited. Saurabh and Nitin, please share, more about your background. Would love to know, about the detailed experience that you had, and I think this is super valuable to the audience today as well. So I'll let you take it forward from here.
Yeah. Thanks, Hemant. Thanks for the introduction. I think you've covered quite a bit of it. Uh, it's great to be here and providing inputs to the US-based investors on investing into India. In terms of my background, I have almost 20 years of investing background, predominantly in India. I've done all kinds of investing, which is private equity, venture capital, and public markets. So that's the kind of nuance of my investing. My partner Nitin has 21 years of experience. We know each other for 24 years. He was my wingmate at IIT Kharagpur. So we've known each other for very long time, and we've come together for starting this fund. Idea is to generate long-term returns for investors, and it's a startup fund. We started in the month of August for the India fund, and for the US fund, we started in the month of October 2024. Nitin has 21 years of experience, as I mentioned, and he also has a whole wide variety of experience in terms of private equity and public market. So all three gamuts and also venture capital. So all three gamuts of investing kind of styles. What I'll do is we'll cover a few things and we'll talk about our profiles a bit more in detail. Nitin would be covering in later in the presentation, but we'll do that later. Uh, in terms of the disclaimer, given that we are regulated in the US, so our compliance etc. is much stronger than any other India-based fund. So all anything which you hear in this presentation etc. You have to understand the disclaimer that this is not a professional advice. You have to speak to your consultant, which is tax advisor or your financial advisor before taking any investment call. We have used some third party information etc, but that is as much reliability as you can take. Obviously we'll have limited liability, and we are not endorsing anything else on this one. So please read the disclaimer of the presentation, and our in terms of what we are trying to cover, we'll take 20-25 minutes to do the presentation. And that would cover predominantly most of the topics or most of the questions which people have asked us. So we would be covering those, and then we'll be opening for the Q&A session, where anyone can ask a question which is specific to their needs and requirements. So the four buckets of things which we would be covering is the first one, which is where we are planning to invest. So which field are we going to play in? So it's essentially the Indian stock market. We would be covering the unique traits and why we invest in or we plan to invest in small and mid cap. So what is the rationale for that? So that's the part A of the presentation. Part B of the presentation is, if we have identified that, okay, small and mid cap is a good segment to invest, then how are we going to invest in that segment, and what value we bring to the table as a fund manager? So that we would be covering in part B. Part C is very relevant for the US set of investors because as you would have seen, okay, Indian stock market is good, etc. But accessing that stock market is quite difficult, and there are a lot of challenges which are there in accessing those stock market. It could be PFIC, could be new remittance tax which may come up, or it could be tax filing, etc. So we would be covering the unique structure which we have created in part C, which essentially kind of takes away all those nuances, all those hassles for the US based investor. And it's very simple. It's like investing in a US stock. It becomes that. So you are able to access market in that way. The fourth part, and which is the very important part, where we would be covering our background in a bit more detail. The other portions in that it would be skin in the game. I think it's predominantly, it's very important. It's like eating in a restaurant where the owner also eats. Where owner eats on a daily basis. So two things which you can figure out from that one is, one, his or her interest is totally aligned with the interest of the customer there, and also the quality of the food, the hygiene, etc. is there, because his or her family is also eating in the same restaurant. So I think the skin in the game is very important, and we'll also be talking about the performance of the limited performance which we have had in 8 months. Now going to the first part of the presentation, which is India. As we all know, and we have all seen when we travel to India, that the growth rate is just astounding. You can see the bridges coming up. You can see the entrepreneurial skills in people. You can see the new businesses opening up. You can see the UPI payment transfers, etc. So there is a lot of buzz and enthusiasm about the Indian economy, and which is then reflected in the growth rates, as you can see in the presentation. India is the large economy. So there may be small economies which may be growing faster, but in terms of the large economy, which is of a big size, India is the fastest growing. And India would be contributing around 15% to the global growth in 2025 and 26. So it's going to be a substantial part of the global growth story going forward. So India, as we know, is the right place maybe to invest. And when we say investing, it's not like we are saying that, okay, only invest in India. It's like part of your money should be invested in India, given that most of us are NRIs and we can see that growth happening. So there is an affinity towards the country, and we know the country. So it's a good investment opportunity as part of your investment. It cannot be the full investment, etc., but part of the investment should be considered investing in India. Going on the growth drivers, why is India expected to grow fast? We all know about it, so I'm going to skim through it pretty fast. One is, I think, yes, we have the young population with the growing, rising disposable income. As you can see, there is so much of queue for the airlines. There's so much of queue for all kind of entertainment options, for the movie theaters, etc. So there is so much of disposable income which people have, and now people have actually started spending it. So that is the change which has come after COVID, where India was a saving economy, but now people have started also kind of spending that money. The other one is, it's a lot of business-friendly policies, etc., which are there for last few years. And the one big change which has happened after Liberation Day is that there is a big change in the supply chain. It's essentially a game which was played in the global economy, and which is being now reset. So that provides a big opportunity for a player like India. If the game is reset, it kind of gives an opportunity for getting the manufacturing jobs, etc. So these are the growth drivers which are there. Now, with this growth drivers, I think we also need to understand is the unique traits of the Indian stock market. Now, it's not as comparable to a US stock market. So what I'll do is I'll benchmark the Indian stock market with the US stock market, with given most of us would have some amount of familiarity with the US stock market. In terms of return, it's a high growth and high return potential market. Now, why do I say that? As I've written in the as we've written in the slide, last 15 20 years of index return, which is the large cap Nifty 50 return, has been 15% in INR terms. And this has been during a period where nominal GDP growth rate has been around 10%. So it's essentially a real GDP growth rate of 6-7% and an inflation of 3 to 4%. So that translates to a nominal GDP growth rate of 10%. Now, nominal GDP is, as we know, GDP is contributed by three parts, which is agriculture, services, and manufacturing. And agriculture doesn't grow at that fast pace. So it's essentially manufacturing and manufacturing and services which is growing faster, and hence the earnings of those companies which are listed are growing faster than the 10%. And typically, as everyone knows, the market return is on a longer term is highly correlated with the earnings growth, and hence 15% has been the return in the past. Going forward, what do we expect? So we expect a growth rate around 6.5 to 7.5% in real terms, and inflation of 3 to 4%. So that gives us a nominal GDP growth rate of 10 to 12%. It's also being talked about by eNRI and PwC. So that's a kind of growth rate which we are expecting. And given that, I think our expectation is the market return would be around 13 to 14%. The other key unique traits is it's a versus any other emerging market, it has a very strong domestic flows. So after demonetization, a lot of people have started investing in the stock market, and mostly through the SIPs, etc. So even if there is a big global risk which happens, this kind of cushions the market. So one has to factor that in. It's a diversified market. Like US is very dependent on the top 7 or 8 stocks. It's not the case with India. It's a diversified. All kind of industries have a good amount of fair share in that. It's a entrepreneurial. It's family owned. So the promoters, which is a majority shareholder, owns a lot of stock in the listed companies, and that obviously comes with their skin in the game. But it also comes with some amount of risk. As we talk about, there are a lot of corporate governance issues, and we would be covering the corporate governance issues in the next slide. There are a couple of things which are important for the US investor. One, I think when you're investing in the Indian market, one has to factor in that there will be INR depreciation. It historically has been around 2.5 to 3%. And one can average it over a 15 to 20 year period. So one should factor in that would be the kind of loss which would happen once you translate the INR, which is rupee returns, to a US dollar returns. So that one has to keep in mind. And as I talked about, India market is very good, but it's not easy to access that market. There are those issues, etc. Demat account, you can bank account, repatriation, so tax filing challenge. So it's not easy for NRIs or foreign investors to access that market. Now, coming to corporate governance, I think this is a very big issue which we wanted to highlight. Even a company like IndusInd, as we would have heard, which had a market cap of 1 lakh crore, which is essentially around $12 odd billion, which is a Nifty 50, which is a large, big company, had a corporate governance issue. So that is the amount of corporate governance issues which are there in the country. We had issues with Zee Limited, which was the largest broadcaster. Broadcasting company. So those are the kind of issues which are there. What it talks, what the takeaway from this is, yes, Indian market is growth, has high growth, has a very high potential, but one has to be a skilled investor to navigate the market. One has to be an investor where knows what are the risks in the market, what are the corporate governance, etc. And that's where our experience kind of come in to navigate the market, because if there is any corporate governance issue happens, there's a sharp fall in the performance, and which kind of can impact the investor returns. Now, if India is the good story, why are we playing in a small and mid cap? It's like small and mid cap is a field. So if say I'll give an example. If you have a field and you can grow either rice or wheat on that, or you can grow something which has a larger difference in demand supply. So if you're growing something which is a larger difference in demand supply, say you are growing pulses, your expectation is that your return would be higher than a wheat or paddy, which everyone is growing. So it's this large cap is where everyone is investing. There is high institutional ownership, there is high analyst coverage, so everyone knows about those companies and what is happening with those companies. So that drives the return of around 15 odd percent. And if you're doing something slightly more risky, which is small and mid cap, there is a potential of generating higher return than 15%. So that's the alpha of 3% which we are trying to generate using investing in small and mid cap. And any alpha which is higher or any higher return than 18 17 18% would be the skill of the fund manager if they're playing in the small and mid cap space. But obviously any kind of return comes with some amount of risk, and those risks have to be navigated, as I talked about. One is the corporate governance risk, and second, those risks, those companies have to be evaluated on a fundamental basis, because there's a lot of information which is unknown, etc. And that's where our fund, as a fund manager, our skill comes in, and that's where there is an opportunity to generate higher return for the investors. Nitin?
Yeah, thanks, Saurabh. This slide basically talks about how we invest in the fund. Coming from a background in private equity, we bring a ownership mindset to the investment process. The fund will have very concentrated portfolio. It won't be like a mutual fund with a large number of stocks. We'll pick up a select concentrated portfolio of 15 to 20 stocks, which we would be very comfortable with because we would have done a lot of research. Our background in small and mid cap private equity investing, where information is limited to begin with, allows us to think that we can do a good job of understanding these businesses really well, identifying their competitive modes, identifying the stakeholders that are there in each of these companies, and the drivers, growth drivers that exist. We believe that our experience in this space has allowed us to be a little more selective about what we do and how we judge these companies. Having said that, the primary important feature that we look for is management quality and corporate governance. These two are not negotiable for us. In the companies that we choose, we tend to focus a lot of our time and effort in understanding these two aspects: the quality of the management and the corporate governance. Now, this we do in two ways. The first thing is the track record of the management, whether they are sticking to what they are saying, whether they are saying the right things, and whether whatever they are saying, if there's any bad news, are they being prompt enough and honest enough to accept it and say it out. As Saurabh was mentioning, there's a lot of minefields that small and mid cap investing really entails in India. But if we have a good quality management to begin with, as some of them are already resolved. The next thing we look for is reasonable valuation. Now, I would love to say that I have a number on which, below which only we would invest, but the reality is that is not true. We look for numbers that are dependent on the circumstances and the industry in which we are. Typically, we look for PE ratios that are less than the 5-year mean PE ratios. We look for companies where we see that the ratios are reasonable in relation to the other companies, and where we see that there is a potential for either reversion to the mean or a potential for expansion, PE expansion as well. But that is not the primary goal or the primary reason why we invest. We invest because of the company and the quality of the management that it entails. Uh, the other thing we've realized is that a long term holding period of 5 years at least ensures that a lot of these one business cycle will allow us to understand how the different PE expansion and contraction happens, how the business is performing, and some of our mistakes will get covered by virtue of just the business growing. Even if we have paid a little extra in our valuations, with a long enough holding period, we believe that that will get equated. Next slide, please. Nothing new here. Any value investor will essentially talk the same things, but let me reiterate. Long-term perspective, buy and hold, 5 years, as we said, minimum. Um, I wouldn't say that our uh, holding period, our favorite holding period is forever. I don't think that is true. We have certain drivers, and as long as those drivers are being met and no red flags that we've identified or are just come out of the blue, no black swan event happens, we would love to keep holding those stocks. Um, we want to buy companies which have a margin of safety in terms of the valuations, which is why I said we try and look for discounts from 5 year means and discount to the rest of the industry if possible. So we try and ensure that there's a margin of safety in everything we do. We focus on quality, sustainable competitive advantages as they exist when we invest, and as they continue to be as when we are monitoring it. In case these tend to vanish, we would also relook at our investment and might exit the same. We do not do anything that is very different from just buying positions in the secondary market. We are very cautious about the liquidity that exists in the companies that we invest in. We are trying to ensure that the position that the fund makes is liquidated easily. Our target is to have such positions only that we can liquidate them within 7 working days. Uh, we don't want to get stuck with illiquid positions because that can go either ways. While some of the stories that we see of stocks that have grown multifold happens because of illiquidity, there are even more examples of companies that have gone awry and investments that have gone awry because of illiquidity. We try to be patient and disciplined. This essentially means that we don't take up a full position at any given point in time. Uh, the fund, across the two funds, we are still at 30% cash, in spite of being in the markets for the last 9 to 10 months in the India fund and about 8 months in the US fund. We are still in 30% cash. None of the positions we have filled out completely. We have a certain benchmark of price that we want to follow, and we wait till we get that price, even if it takes some time. So that's the kind of discipline we are trying to follow. Um, 5 years and longer term investment horizons clearly need that we show patience. We believe that our background in private equity and investment banking for Saurabh, VC, and public markets for me, and having run businesses as private equity owners of businesses, uh, we tend to understand business from an analyst's perspective, from an investor's perspective. Um, so it is the proof is in the eating of the pudding. So we'll figure that out. But as of now, we believe very strongly that we have a superior business understanding. Um, Saurabh, next slide. You're muted, Saurabh.
Yeah, thank you. Sorry. So given that we already know that it is lucrative to invest in India, it's lucrative to invest in small and mid cap companies, and we as a fund manager have the skills to navigate the market and navigate the risk, etc., to generate the higher return than the index return. Now, how are we planning to do it? So, what is the unique part of our structure? Our structure is very unique in terms of it's like invest in US dollar and redeem in US dollar. It's like investing in a US stock. Uh, so what it helps is there are no PFIC issues because you are investing in a local vehicle. there are no potential any remittance tax issues, because there is no remittance which happens. There is no exposure to Indian tax authorities. There is no repatriation risk, etc. And there are no requirements of PAN, Aadhaar, address proofs, etc., which kind of happens. So what we do is we have a vehicle in the US which kind of takes in the money, which is Compounding Gems Aravali Fund. It's a vehicle based in Delaware, where all the investors, as we've shown, kind of invest money. The fund manager or the investment manager is based in the state of Texas, and it's registered with both the state of Washington and Texas. We This vehicle, which is the Delaware vehicle, is registered as Category 1 FPI in India. So it is registered with SEBI, which is the market regulator in India. And with that, and Category 1 is the highest rating which a FPI can get. It's equivalent to a sovereign wealth fund kind of thing. So what we have created is a structure which is top end kind of structure. And with that structure, that fund invests into India. It creates a portfolio of companies and generates return. As and when there is an exit event which happens at the portfolio level, the fund pays the tax in India. The investor, which is investing in the US entity, does not pay tax. The fund pays tax, and that tax is reflected in the Schedule K1, which is issued to a US-based investor. So they get the credit of the tax which has been paid on their behalf in India. So that happens, but and hence there is no taxation which a US investor has to file. Any kind of repatriation which happens from India, say we have exited a company and we want to repatriate that money back to the US, that is done by the fund, and that's not done by the investor. So that also kind of helps navigate those regulatory challenges. Now, given that we are a startup fund, we get a lot of questions around what are the fund operations, how transparent are you, how do you manage money, etc. So I think what we do is the investing in our US fund is like opening a credit card in the US. So first, if there is an interest, we explain, you kind of put your interest on the INRI website. It comes to us. We kind of have a conversation with you. We kind of explain to you what the product is, etc., etc. If there is interest in that in our fund, as a next step, what we'll do is we'll ask for some income documents to ascertain that you are an accredited investor. And it's a standard definition of an accredited investor. The documentation, verification, etc., is done by a third party. And once that verification is done, and that those documents do not come to the fund managers. Once the verification of income, etc., is done, then we send the documents of the fund documents on an online basis, which is for online signing. Once the investor signs those documents on an online basis, the investor has to then transfer the money in a US bank account, once they transfer the money, the investment is done. So it's as simple as opening a credit card. With everything can be done in US and on an online basis. And when the exit happens, the money also flows from a US bank account to the investor's bank account. So it's as simple as that. In terms of fund operations, we have hired top tier service providers which are market leader in their own space. So the custodian is HDFC Bank. The tax filer for us in India is a big four company called PwC. In the US, we have an auditor which audits the fund accounts and also provides the Schedule K1, which kind of flows into the tax filing for the investors. That's done by Spicer Jeffries, which is again one of the top firms in the US. Now, what some of the things which I will talk about is one, whenever the fund is invested, the fund cannot be, or money is invested by investor, that money cannot be touched by the fund manager, because those are that's essentially what the regulations say. That it's a ring fenced kind of money where the transactions are being done either by the fund administrator, which is NAV Fund Services, or by a custodian. Even the shares which are owned by the fund are kept by the custodian. So the fund manager has no access to the fund. So that kind of that is how the regulation is. And the fund accounts are audited on an annual basis, and we have to submit to both Washington State and the state of Texas. So that is where that kind of helps in terms of the transparency, etc. In terms of communication, the fund provides a monthly NAV. So that would come from the NAV Fund Services. And fund manager also provides a quarterly newsletter. The quarterly newsletter would have what is the performance of the fund, what is our view of the market, etc. So you can envisage very similar to a Buffett letter, which comes on an annual basis. In this case, we'll do on a quarterly basis. What is the fund holding? Which shares have we bought, etc. And why are we buying that? So all those information is provided in our in our quarterly letter. And as I talked about, the taxes, etc., are being filed by the fund in India, and they get the investors get the benefit of those taxes, etc. So it's all transparent. It's all and a proper communication channel is there. So what we have done is, given that we are a small or a startup kind of fund manager, we've kind of tried to engage all the top guys to ensure kind of trust or build trust over a period of time. Nitin?
Yeah, so while this is a first time fund, we are not first time managers. Uh, Between both of us, we've managed at least three funds each. Uh, so both of us met in 1998. So it's been 27 years that we've known each other, and we've been friends. We've not worked together prior to this, but we were learning and gathering experiences. Um, Saurabh's experience has been in transactions, big transactions, small transactions, international transactions, both as an investor and as a banker, which gives him a much broader view of, of the world than I have. I have primarily been a small and mid cap private equity investor. I have also been in the public markets in the last fund of mine. For the last 10 years, I've been doing public markets in India. Again, focused on small and mid cap ideas. But my background has been in private equity, doing small and mid cap. So we understand this space. At least we believe we understand this space. From a pedigree perspective, uh, IIT Kharagpur, I am Lucknow, and I have a degree from Stanford Graduate School of Business as well. Um, Pretty much, we are who we are in front of you. Um, Cumulative experience of more than 40 years. We've seen three business cycles in these 20 years of our experience each, from different sides of the table, that allows us to really have a good discussion whenever we're having, bring in different perspectives, um, bring in new voices, because we have different networks. We've created big networks in the industry, in both from the operations side as well as the investing side. So different voices, different perspectives, we keep sharing and fighting about with each other. That's part of the experience that um, team that we have, and we work as. As I mentioned already, public markets, VC and PE, we've done it all, hopefully seen it all. Um, and in that period, we've invested about $300 million in our previous avatars. For that, we've evaluated more than 500 investment opportunities on the unlisted side, as well as about 250, 300 odd companies we have evaluated in the last 3 years in the listed side, between Saurabh and me. Saurabh, next one, please. Now, this one is the big one. The two funds right now have money that has been provided by the management team, by friends and family. And so we do not have the luxury of running away with this money or doing anything very adventurous with it. We have to understand that this is money which we are responsible for. Um, we are not trying to just manage third party money without having any skin in the game. Obviously, if anything goes wrong with the fund, it affects us directly. So we are very cautious. This ensures that we do not do anything that is too adventurous or that has the potential to really lose capital. We don't have that luxury. Uh, a significant part of our net worth is invested in our funds. So we don't have the luxury of being callous about it or being adventurous about it. So yeah, skin in the game is very important. As Saurabh mentioned at the beginning, we eat our own pudding on a daily basis, and we hope that this is something which allows us to do well, and that can be seen in our performance. It's too short a period right now for us to be able to say that we are the best. No, we are not, but we surely will be amongst the top 4 or 5 funds that are India focused, but in the US. So, from the investment set that you truly have as an US investor, uh, we would be easily in the top 4 or 5 funds. So, we hope to improve this performance as we mature, and as the portfolio matures, we are hopeful that things will look up. Saurabh, you want to add anything to this? You're muted, Saurabh.
Oh, sorry. Uh, Again and again go on mute. So our performance is 6.8% down versus the index. Index is down 8.2%. So there is a outperformance around 1.4% in a very short period of time. In terms of other options, US based investor for the thesis of investing in US dollar and redeeming in US dollar, there are some those ETFs, etc., and NAV and the mutual funds which are listed in the US where we have kind of highlighted them. And as you can see, we are kind of outperforming even those indices. The one which we are not outperforming is India 50, which is essentially the large cap index, because over the last 7-8 months, the large cap has outperformed both small and mid cap, which typically can happen in a short term basis, and hence there is less down versus a small and mid cap fund, and any other small and mid cap fund which is like MSCI or MSCI small cap, that's down 30 odd percent versus our 6.8%. So we have been kind of very resilient in the market. In terms of the investment size, our ticket size is $200,000. Our fee structure is 2.5%. I think we would provide those details in the FAQs, etc. At entry. And the lock-in period is 1 year. We are looking for investors who can invest for at least 4 to 5 years, because that's where, as Nitin mentioned, there are you can see a cycle and you can generate a good amount of return over a 4 to 5 year cycle. In short duration, there could be risk, there could be a lot of volatility, like now US has nuked the Iran, so there could be some market reaction for that. So any kind of those kind of market reactions impact the short term performance. Over 4 to 5 years, those performance kind of get adjusted, and hence we are looking for investors who have a slightly longer duration of investment horizon. Yeah, I think Hemant, we are done with the presentation. Sorry, I think we've exceeded by 4 or 5 minutes.
No worries. So, thank you, both Saurabh and Nitin. I think this was really informative and at the same time, very interesting structure on how to, invest from the US and without kind of converting dollars and then worrying about it for repatriation. Um, so we'll use the Zoom chat for Q&A. So feel free to ask questions. I can already see some coming around. I will also post this link. So we are also launching with this fund, and you can, if you have more questions or want to reach out to the team in person one-on-one, feel free to use the form there. We've also put up content around FAQs and then talking about the fund. So I think super helpful to kind of go through and reach out if interested. So we'll begin with the Q&A. Saurav, I believe you can see those questions, so feel free to answer
Yeah.
in that
So
order.
I'll start running through the Q&A. The first one is there any lock-in period for the investors? I've already talked about, yes, there is a lock-in period for a year. And the idea is that we want long-term investors, and hence we've kept the lock-in period of for a year. The second question is, are you registered with SEC? Now, the registration in US is a complicated structure concept. what happens is US has both state regulators and SEC. Any big fund which has a asset under management of more than $150 odd million or $110 odd million, that has to register with SEC. All the other funds which are smaller funds have to do the state registration. So hence we are a smaller fund, so we cannot register with SEC. We are registered with two states, which is the state of Washington, which is a very tough registration to get, and the state of Texas. So we are registered with both states. We are allowed to raise money from all the states. It's just that more than 6 investors from a state, or even one investor, depending on the state regulations, we have to do a blue sky filing. And we would do that. But in terms of regulatory framework, both SEC and the state regulators have the same regulatory framework. So we go through the annual audit. We have to submit even the accounts of the fund manager, and net worth criteria, etc. Everything has to be met, and we are subject to audit by both state regulators. So that's the play for the regulator. And in terms of the fund is also registered with SEBI in India, as I mentioned. So it's a Category 1 FPI. So we are also registered in India, and hence our registration is kind or our compliance, etc. It has to be quite robust to manage this one. Nitin, sorry, the next one is what happens if I move back India after 2 years? Now, it's a very good question. I think we would have to check with lawyers. But what happens if you move back to India, you would be able to keep some money in the foreign accounts. I don't think it's required for you to repatriate that money on an immediate basis. It's a choice which we can have. Some people manage or maintain that money for kids' education, or any other purpose, say investing in the US, etc. So you can keep that money in the US and invest it in the fund. However, I think given that we would be under the SEBI regulations, etc., also in FEMA, so we would have to double check whether you would have to invest our fund or not. But what I understand is you can keep money in the US, but in terms of investment with a fund, we would have to check and come back to you on the exact thing.
Just to add to that, we have an India fund also. So we would be happy to return your money in the US and then get you to invest in India if that is something that is of interest.
Yeah, India fund is a Category 1 AIF fund. It's also registered with SEBI. Category 3 AIF fund is registered with SEBI. The minimum ticket size in that is 1 CR. The underlying portfolio is same. So hence we have two vehicles. One is for India investors who have, or US investors who have money in India. They can invest in our India fund. And they would have to then do the tax filing, etc., which like investing in any other place in India. Or we have a US fund which kind of obviates all those kind of issues. The next one is, do you cover currency risk by hedging the currency? No, we do not. What we've seen over a period of time is that any kind of hedging cost for managing that currency risk comes to be almost same as the currency devaluation which happens. So the hedging cost is around 2.5-3%, and versus the depreciation, which is also 2.5-3%. So there is no arbitrage, or there is no benefit of doing a currency risk. So hence we have kept the currency open. Going forward, it's a very it's historically it has depreciated around 2.5-3%. We have a slide on that. But going forward, we believe that it may not depreciate by 2.5-3%. One, I think the risk-free rate, which is the 10-year yield for the two countries, now the differential is not 2.5-3%, which used to be the case. Now the differential is more like 1.5%, where US 10-year yield is somewhere around 4.6-4.7%, and the India 10-year yield is around 6.1-6.2%. So that is a gap of 1.5%, and that is typically the currency depreciates on that gap basis on a longer period of time. So we believe that the depreciation is going to come down. That is one. And given the issues with the US economy and the USD as a global currency, etc., coming down over a very long period of time, the currency depreciation at some point in time may end. because of the inherent issues with the US fiscal situation, etc. So one has to factor those two in. One, I think the depreciation is going to come down. Our estimate is depreciation is going to come down from 2.5-3% to 1.5%, and maybe may not happen also. So one has to factor those kind of things. Uh, the next one is how much is the fee, and is it one time or recurring? So the fee is 2.5%, and it's an annual fee. It's like any kind of expense ratio which a mutual fund has. So it's the asset management fee, and it also helps us manage the structure, which is there is some cost associated with managing the US structure and the compliance, etc. So that kind of helps cover the cost for that structure, and that is why the cost structure would seem slightly higher. There is no performance fee for accredited investors for any qualified clients, and qualified clients is anyone who has a net worth of more than $2.2 million, other than primary residents. For them, we have a different fee structure. But for an accredited investor, which is like anybody who has an income of individual income of more than $200,000, or combined with spouse income of more than $300,000. So those people are accredited investors. For them, the fee structure is 2.5% of management fee or of NAV, which is the net asset value on an annual basis, and there would be no performance fee. For qualified clients, which I talked about, the fee structure would be slightly different for them. The next question is, do you have any historical performance for similar thesis? In the US, large cap has always outperformed the small and mid cap. Do you think it is different in India? As you can see, I think now everyone has access to Grok, Chat GPT, etc. You can figure out it's a very easy query of what has been the last 20 years of the index return or for a small mid cap company in India. The answer which is thrown is that a large cap fund, which is Nifty 50, has an index return of 14.5%. And small and mid cap, depending on which one you choose, on an average basis, the return has been 16 to 17 odd percent. And historically, that has been the gap of around 2.5% is the gap between the small and mid cap. Now, there could be a scenario where, say, US is a very unique case. US, the returns have been predominantly dominated by the Mag 7 companies, which are not large, which are ultra large in their size. So that's what is driving the return. But this is a very unique case in the US, but not the case not the case in India. Nitin?
I agree. There hasn't been, we don't have companies that are world dominating or which are there across the entire globe. We have companies that are primarily focused in India. Some of them have some portion of their investments um, that are exports and exports oriented, but we don't have any large ultra mega companies. Nifty 50 has been there, but because of the fact that there has been a margin expansion, and a PE expansion in the mid cap and small cap companies, they typically have outperformed over a longer period also by 2.5% wherever they have survived. The 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 distinction here is that you have to be very careful about mid and small companies to see which are surviving, which are not having corporate governance issues, because once you take those companies out, then there's outperformance. In a lot of cases, you end up with duds because the companies themselves delist because of bad due diligence on the part of the fund manager.
Yeah, thanks, Nitin. The next question is by Satish. It's can we invest in INR in India and get back in US dollar? So structurally, that's not possible. Alternate are two. One is you can invest INR in our India fund. As I talked about, the minimum ticket size is 1 CR, which is 1 crore. That's the SEBI regulation. Or the second alternate is we can help you repatriate the money in US, and that we can work with the banks, etc. But we can just help you introduce and help with the banking connections, etc. There we can help repatriate. The repatriation, I think, given that you are an NRI, is US dollar 1 million per annum. I think which would be substantial. If you have more than that, then I think you would have to split it over two fiscal years. And once you get the money in US dollar, you can invest in a US fund. So that is how I think it can happen. but we cannot take money in INR because that would be circumventing the regulations. This product is only for US dollar investors, or could be foreign investors, etc., but not for an Indian investor with money in INR. Or, sorry, not an investor with the money in INR.
For that, we have the other fund.
Yeah, for
the
that we have
domestic fund.
the next question is, what is the minimum investment for individual investor? This is by LN. So our minimum ticket size is $200,000. So that is the kind of minimum ticket size we are looking for. And that is the minimum investment for an individual investor. The comparable number for a gift city is, I think, $150,000. Comparable for because this product is more for a sophisticated investor. We are taking slightly higher amount of risk given the concentrated portfolio, etc. In the hope or in the hope of trying to generate a higher return. So that's why the regulatory requirements for the minimum investment, etc., is higher, even for a gift city or for an India fund, which is once a year, which translates to somewhere around $120,000. So we have benchmarked a minimum investment with these two numbers, and we have kept 200,000, so that we are able to get people who can take that kind of risk, and in the hope of generating high return. Typical return which people have generated in this Indian small and mid cap in rupee terms has been somewhere around 20 odd percent. Any good fund manager who can get an excellent grade as a fund manager. In schools we used to get grades, right, which is excellent, A plus, whatever. So any fund manager who generates a 20% kind of return would get an excellent grade, and that's what we would be targeting in INR terms. Obviously, the returns in the US dollar would be lower. Okay, the next question is Lokesh, which is from Lokesh. What is the minimum investment amount, which I talked about? Please go over the fee structure in some detail. This is what I talked about. So I'll explain fee structure again. Say you invest $100 hypothetically. So the first year fee would be $2.5 on that $100. Next year, say your NAV has increased from $100 to $120. So that next year the fee would be 2.5% off that $120. It's very similar to a mutual fund where the fees is on the NAV of the fund. Next year, say the number has increased to say $144. Then the fee would be 2.5% off the $144. It's an annual fee of that management fee. There is no performance fee. So if the fund gives whatever return, etc., the return would be provided to the investor. So that is the fee for an accredited investor. And as I talked about, accredited investor is anyone who has an income of more than $200,000 individually, or as with spouse or a family income of more than $300,000. There are a few other criteria which are there, but those are very nuanced ones. The main criteria which people meet is this income criteria. The next one is from Anita. Do you intend to remain of the size so that SEC registration is not required? No, we do not intend to do that. As we grow our fund, at some point of time, our fund would be multi-jurisdiction. Our fund would be more than $110 odd million. So at that point of time, we would be getting SEC registration. There are no difference in regulations per se. It's not like the state regulations are any light versus the SEC regulation. It's just that the regulatory body is different. The regulations are essentially the same. So at that point of time, we would get SEC registration if our AUM grows more than $150 or $110 million, depending on the case. And because compliance is essentially the same. And at that point of time, it also becomes easier for us to raise money from multiple states. We would not have to do blue sky filing in all the states. That is typically avoided. So there are some benefits of the SEC registration itself. But what they have done is the US, given the dual structure of a state versus the SEC, to keep the relevance of state, because they keep earning some fee out of these funds or of funds of our nature. They have kept the relevance of the state, and for that they've kept the size as one of the factors where it kind of differentiate who has to register at state and who has to register at SEC. But the regulations are essentially the same. The next one is from Abhishek Batra. In case of any unforeseen event like Wazirex happened, what is the state of the investor? So I am not 100% sure. I think Wazir X was not a regulated entity. In this case, we are properly registered with the US regulations. We are properly registered with the SEBI. So those kind of things typically cannot happen. The both regulatory environments. So we are taking money in US and investing in India. Both regulatory environments are very stable. People have been doing this for more than 50 years. Both picking up investing from US to India. So it's not like a new regulatory environment which is going to come up. Now there could be risk, there could be edge cases where say something happens, etc. In that case, we'll return the money, but the probability of that is very low. Given that the friendly relations between India and US, etc., so that is not going to happen, and both are very stable regulatory environments. So there cannot be a situation like Wazirex, and given the US regulations, we have to do the fund audit. We have to provide the audit to the regulator both in two states. Given that we are registered in two states, we have to get our even fund manager audited and provide those audited returns to the regulator here. All the money which is raised by the investor is ring fenced. Even the stocks which are owned by the fund on behalf of investor is ring fenced in a Demat account in India, which is managed by the custodian. So it's a proper ring fenced kind of structure, and this is a structure which has been there for a while. So it's not like new a fund management structure which we are inventing. Wazirex is a crypto kind of platform where regulations are evolving. So this is not it's not a apple to apple kind of comparison. Uh, the next one is, do you cover currency risk by hedging the currency? I think we have covered that one. The next one
We don't
is,
hedge.
yeah, we do not hedge. The next one is family of Cherokee. Sorry if I got the second name pronunciation wrong, my bad. In audited reports, would you indicate percentage indication of uh, uh, top 10 holdings? You do derivatives as well, individual stocks. I think it's a very good question. In our quarterly report, we'll give you holdings of all the stocks. So we typically hold 15 to 20 stocks. We'll give you each name of the stock which we hold and how much of percentage of AUM, which is asset under management, is invested in that stock. So not the top 10, we'll give all the stocks because we are a very concentrated fund manager. So we do not have the top 10 kind of thing, which is relevant for a mutual fund. In terms of our underlying asset, we only invest in equity. We do not take any derivative position. We do not invest in any IPO or any kind of pre-IPO. So it's pure liquid small and mid-cap companies, predominantly small and mid-cap companies where we would be investing. So there's no derivatives, there's no future and option, there's no so it's a long-term investing is what we are trying to do here. Nathan?
No, just to add to that, in our quarterly reports, we also lay out the reasons why we have picked up a stock, why we like a stock, why we have invested in it, and what are the triggers for us to exit as well. So, what can go wrong? We typically have the all of that listed out. A couple of companies every time we do highlight. So we are very transparent in terms of our communication to our investors, uh, because primarily the audience that we have for these are family offices and institutional investors. So from their perspective, it has to be very transparent, and a lot of things do come in our quarterly reports that are very helpful for individual investors to understand the way we think, our outlook for the quarter, our outlook for the year. We put it all out there. So you can hold us to any of the stuff that we are thinking and saying and doing. We are trying to maintain as much transparency as we can without in any ways compromising the returns that the fund would have.
Yeah,
Right.
I think the
That's
benchmark is is what Buffett says, that any investor letter is where, say, if Buffett was an investor and somebody else was the investment manager, what kind of information that a Buffett or an investor would look at, would require. So that is the kind of information we provide. It's like we are investors in our own fund. So what is the kind of information we would look at? What are the kind of details, etc., we would look at? We provide that kind of information in all transparency. I think transparency is and trust is one of the key pillars for us. The next one is Ram. This session is really helpful. Thank you so much. You found you found it helpful. That is quite. Thank you for that. Can you please schedule a session to go through investment in India? I think what you're looking for is investment through our India fund, which is category 3 AIF. We can do a session with INRI. The nuance there is that it's a category 3 fund in AIF. We are not supposed to market that fund. It's same as Gift City AF, which people are not supposed to market because that's the regulation. So we can do a session, but we would have to figure out the whole of how to handle through INRI, etc. But if you need, I think any information, Ram, I think you can reach out to us through the form which is there, and we would be happy to provide you details. And we'll think about of having a session of investment through India fund. That we'll have a chat with Hemant also. Next one is Anita. Sorry, I think yours is a big question. Let me just go through it. Any sample K1 you would be able to share? Can you also share about wash sale applications reflecting on K1? How uh, to how do you take advantage of tax loss harvesting? Do K1 preparer insist on wash sale for your fund or pass on without wash sale to investors? What are typically short-term capital gains generated on K1? So, yeah, so I think good question. Wash sales, I think we typically, it's because we are a buy and hold investor. We once we exit a stock, there would be a capital gains event, and once we have exited the stock, most likely there would not be a reinvestment opportunity because that's where the wash sales come. We are not a trading investor where we kind of keep churning a portfolio. The portfolio which we currently have are the same stocks which we have invested in October. We haven't exited. I think we have exited one stock where we found corporate governance issues. So we have exited that one stock. Other than that, we have not exited any stock. So there are no scenarios of any kind of wash sales. We can provide you a Schedule K1, a redacted one, because Schedule K1 we issued for our investors in the US fund for this tax year. So we can provide the information, but then the details, etc., would be redacted. Idea is that any kind of tax which you pay in India, which is the long-term gain or a short-term capital gain tax, you get a set of that tax in the US, and that you do through a Schedule K1. So we can provide the information. I think you just have to, if you fill in the interest form, etc., we'll provide on a one-on-one basis rather than on a generic basis. There are no wash sales which can happen. There's no tax loss harvesting, etc., which we do. We are like, it's a long-term investment. So we're not trying to optimize for a tax loss harvesting, etc. What we are trying to optimize is your money of say $100 compounds at 17-18% or at least 14 to 15% net in the hands of investors and 20% on a gross basis, and we do it over a 5 to 10 year period. So that is the whole thesis here. We're not there for tax loss harvesting. It doesn't make sense in this fund, and there are no wash sales. Sorry. So yeah, so I think that hopefully I should have answered that. But if you have any follow-up question, maybe you can ask it. Family of Cherukri, what is your fiscal end? Our fiscal end for the US fund is December 31st. It's like for the US funds. Given the tax year ends are different in the US versus India, how are the tax handled? So what we do is we have the Indian tax authority in our Indian tax advisor, which is PwC, prepare the taxes for the fiscal year, for the US fiscal year. Those are then provided they estimate their taxes, and those are then provided to the US auditor, and basis that the US taxes are or the Schedule K1 is generated. So any kind of exit or a capital gains event which has happened during the year gets covered, irrespective of whether which Indian fiscal year does it lie in. So we, for our tax filing Schedule K1, we follow the US tax calendar, and that's managed both by PwC in India, who provides the inputs for the taxes for that calendar year, and by a US which generates the Schedule K1 basis the taxes are filed in India for that period. The next one is Aniket. If I invest in US now and move to India in few years later, will I be able to withdraw in INR? So if you invest in US and move to India, this is a pure US fund. So if you invest in US dollar, you would exit in US dollars. We typically would not provide any exit in INR. So if you move to India and you want to exit the fund, you would have to intimate us. We'll give a redemption. We'll start the redemption, and we'll transfer the money to your US dollar account. The next one is family of Cherukiri. Annual cash returns will be issued as dividend or capital gain. The reason for this ask is they get taxed differently. So the whatever is dividend would be reflected as dividend. And whatever is reflected as, so there would be a dividend tax, etc., payable in India. And whatever is the capital gains tax, which is where there is a capital gains, that would be reflected as capital gains, and you will be able to get that set off against the capital gains which may come in your US tax filing. So that is how the dividend would be provided as dividend, and capital gains would be provided as capital gains. And those obviously get taxed differently, and hence those would flow from Schedule K1 to your direct tax returns. And for any kind of detailed tax advice, I think you would have to consult your tax advisor. I think we are not tax consultants. The next one is family of Cherukiri. Is this one-time investment or plan to raise funds depending on market condition as tranches? So sorry, I think we missed talking about this. Is an open-ended fund. So you can invest at any point of time and exit at any point of time. So this is not a closed-ended fund where we are raising capital in one time and investing. This is where, say, you want to invest 200K right now and you want to add 50K 6 months or 1 year later on, you can add that much amount. So this is an open-ended fund. This is not a closed-ended fund. And we would keep raising, and as and when the investor interest is there, we can raise capital. The next one is Anita, follow-up question. So when you exit from a stock, are the gains in K1 and actual fund money passed back to the investor or reinvested? The actual gain would be reinvested. The gains would not be repatriated. So the gains would be gains would be reinvested, and K1 would essentially reflect, say 100 has increased to 120. So you would have paid a capital gains tax of on the 20, depending on the short term or long term nature. So that which the tax may be $2 or $3, depending on whether it's a short term or a long term capital gains tax. So that would be reflected in your K1. And we would not be reimbursing for that amount. So to that extent, investor would be out of pocket for that, for 2 or 3. But what our fund does is, because we are holding the investors' investment for long, there would not be many exit events. So it's not like you'll be paying a lot of tax on an annual basis. There'll be very small amount of tax which would be due on an annual basis. So because our idea is to invest in good companies and hold them for long. So idea is not to churn the portfolio. Once you churn the portfolio, then those capital gain tax events come in, and then that's where the investors could be slightly more out of pocket. But in our fund, it'll be minimal to that extent. Nathan?
No, I agree. I think we are not going to do any of the investments from a short-term perspective. We are only going to invest from a long-term perspective, 5 to 7 years at least, until unless there is a trigger, in which case tax is not our primary concern. Returns on the fund are. That is very important for us. Sorry.
Yeah,
Yeah.
yeah. We've got another one. So what is the current fund size? We have a total fund size of $3.5 million right now. That is our current fund size. That is both our India fund and US fund. We haven't marketed this fund a lot in the US or in India. We just raised fund with from our friends and family, and now we are in the market to raise further capital. So this is our initial capital, and it's all predominantly our money, which we have kind of raised for the fund. What is sorry? The next question is what is the fee for India fund, Nitin?
So the India fund is depending on if you're coming directly or through uh, a distributor. It is between 1.5 to 2%. It has a hurdle rate of 10% and a carry of 15% or 20%, respectively, depending on whether you're coming directly or through a distributor.
Carry is essentially a performance fee.
Would you say fund is focused on small cap growth or cash flow focused? Uh, we are a small cap um, growth focused fund. I wouldn't say that we are only cash flow focused, we are more growth focused. We look for opportunities and dislocations in the market where we see businesses that are strong and are available at a good price. Um,
Yeah,
I
but we
wouldn't.
also, as an add-in, we focus on cash. In terms of the cash flow, translation of the growth should be there in the company. It should not be
Yeah.
cash guzzling, where all the growth is there, but there is no cash which comes out of the
So
business.
we'll not invest in companies like Eternal, or a company where or a Nika or any of these businesses where we don't see a translation of business into cash directly. That won't fit into our focus typically.
Yeah,
Next one is what is the sorry India and
India.
US funds are invested as aggregated, or are they both separate? They're both separate funds, but they have the same underlying portfolio. I manage the India fund. Saurabh manages the US fund because we are both raised. I am registered as a investment advisor and manager in India. Saurabh is registered as a registered investment advisor in the US. So from that perspective, these are different structures with different principal managers, but the underlying portfolio is the same, and we work together on all the decisions that we take.
The US first fund invests in parallel to the India fund. So the US fund also does not roll into the India fund. So it's like say a company like Narayana Rudale would have shareholding from our US fund and also shareholding from our India fund, or their own stakes. So both are two parallel investments. One does not roll into another. That kind of scenario is not there.
Uh, will there be performance fees in the funds? In the India funds, yes, there is performance fees. In the US fund for the accredited investors, there's no performance fees.
Yeah, and that is because of the regulatory reasons here in the US. We cannot charge performance fee to the accredited investors in the US. So hence, there are no performance fee, and to that extent, management fees is slightly higher because we, as I talked about, the cost structure for the US one has to be covered. Uh,
Uh, Sorry, I'll take that. Are
yeah,
both investments made together? Yes, they're made together, but it's not like they are made parallelly. They're not made in the from the same structure. It's not that we are like the US is not a feeder fund into a India fund or anything. It's a separately managed, registered as an FPI entity with its own investments, and that is why both of them invest in parallel. So once we like the idea, we do tend to make investments from both the funds. We are very cautious as to ensure that we are not increasing the value or the price of the fund for price of the stock for one fund over the other. We typically wait for the price to stabilize, and we take small bites.
So what we do is, as an operational matter, we trigger the broker is saying who buys the stock in India, and we trigger two emails. One is by Nitin for the India fund, and that provides the quantity of the same stock which we are looking to buy, and at what price level we are looking to buy. So that's a separate email which Nitin writes, and I write a separate email to the same broker for the US fund, which talks about for the US fund how much quantity are we looking to buy, at what price we are looking to buy. So that is essentially ensures the compliance with the regulation. Where in US, I am the fund manager, I am the registered investment advisor, and in India, Nitin is the registered investment advisor. So there are two separate emails, etc., which go to the broker to initiate the buy transaction, and
None
similar
of
will happen
us
for the sell transaction.
Sorry, just the next question that is there is that none of the funds play front runner. We both give price limit orders. So typically, we take the time to buy these stocks. We never buy in one go. Every investment is made over a 3, 4, 5 tranche period, and therefore, and these are price limited investment buys, so no one plays front runner.
Yeah, and
Uh,
the both returns of the India fund and US funds are highly correlated. They are tracking in 0.1, 0.2% difference to each other, because there is some buying timing difference which happens even at the broker level. So that causes a very slight difference of 0.1, 0.2% over an 8-month period. So that is the kind of delta which is there. But we kind of give the typically the buy and sell kind of orders together.
yeah.
The
What is the
next one
return
is,
target? Sorry,
yeah.
I think I just skipped that one. What is the return target in US and India fund? 15 to 20% gross. So anywhere between 12 to 15% net in dollar terms to the US investor.
Yeah, and I think that we as a fund manager cannot provide a target return, etc., because it's subject to market risk. As I talked about, anyone who gets an excellent grade as a fund manager would target a 20% kind of return. So that is, I think, where we would and we are highly competitive, so we we would want to get an excellent grade. So let me I'll put it that way.
Uh, Next one is from Anita. Is a custodian absolutely necessary? The charges from custodian do add up, and there would be some delta between India and US fund. Any comparison would you have to share? Custodians are absolutely necessary for both the funds. It is the India fund as well as the US fund has custodians in
Regulatory.
India. That is a SEBI requirement. So what we've done is we've used our relationships to bring down the costs to the bare minimum possible. We keep getting cribs from the investor, from the custodians, that we've really beaten them down on price, but that is what it is. Uh, it is an important part of the regulation, and from an investor's perspective, it also ensures that we cannot touch your money, touch your stocks. We can only suggest and tell these guys to do it. For the US fund, it is HDFC Bank that is a custodian. For the Indian fund, it is Kotak Mahindra Bank. And as you would appreciate, two fund managers trying to talk to any of these institutions and asking them to do any hanky panky just doesn't cut it. So it is important, and I think it's a very good um, step that SEBI has taken to ensure the success, the uh, safety of the investors' money. There are a lot of people here who are doing investments directly or through different unregistered structures, but obviously there's no protection to an investor if any of them go rogue. In our case, we can't go rogue. If
Yeah. So
before we affect you, everyone else will be on our heads.
So
Sorry, Saurabh.
even for the US fund, it's a regulatory requirement. So while in the process of getting an approval, we had to submit the name of the custodian. And idea being that historically, when the fund management industry was not regulated properly, there were a lot of fund managers who used to raise money and run away with the money. There was a structure of Wazirex kind of situation could also happen. So for safeguarding the interest of the investor, both US regulator and from the US regulator, Indian regulator also learned, SEBI, and hence for both India fund and US fund we have custodian, and that kind of essentially ensures that the fund manager doesn't play foul with the investors' money, and ensures that uh, the investor can sleep properly, and that their money is properly ring fenced to that extent. Yeah, I think we have covered all the questions. Hemant. I'm not sure. I think some other question has come through. Sorry, sorry, I'm not clear about how custodian. So what happens is in a safeguarding role. So any money, I'll explain a bit more detail and slowly. When we raise, say, capital in the US, I'll give you an example of US. Say you invest $100 in US. That money we accept in a US bank account, which is managed by the fund administrator, which is a third party. And we give instruction as a fund manager to transfer that money into India to invest. That money from US gets transferred to India, and the instruction is generated by the fund administrator, which is NAV Admin Services. We cannot issue a transaction notification on that. Once the money goes to India, that money comes with the US dollar INR conversion happens. Say 8,500 rupees gets converted. That money is deposited in the Indian bank account. We ask a broker to say buy Narayana Rudale shares, which may be trading at say 85 rupees. 100 shares we ask them to buy. So the broker would deduct that money from HDFC bank account, and that money then bank account would become zero, and the Demat account, which is managed by HDFC Bank, would get credited by 100 shares of Narayana Rudale. Now, safeguarding happens is any fund manager, as a fund manager, I cannot give an instruction of that $100 which we have raised in US. One can come to our personal accounts. We cannot give instructions of that $100 while it being transferred to an Indian bank account. It cannot be our personal bank account. We cannot make any payment to a related party because those transactions are checked by fund administrator and by custodian. Once the money, say 8,500 rupees, is there in India, we cannot ask the bank in India to transfer it to my personal account or to buy my personal shares or anything of that sort, because that transaction is also vetted by the HDFC Bank in India. So the whole process is to safeguard that $100 which we have raised in US and ensures that it goes in a proper place where we have kind of agreed with the investor where to invest, and it doesn't go in our pockets. So that is the safeguarding which is ensured by the custodian and the fund administrator.
Just to add to that, what happens here is that all of this is covered by the agreements that we sign with you. So the custodian also is a party to the agreements that we sign, and therefore what they do is they take every instruction that we say with respect to the agreement that has been signed. If we say anything that is out of that agreement, they just don't accept it. So whatever you've signed, whatever you know that we've committed to you, only that gets executed, and these custodians are statutorily responsible for the same. If anything goes wrong tomorrow, you are going to actually talk to the custodian and ask them how it went wrong, and they would be liable for the same. Which is why it is just not us that you'll be questioning. You'll be asking these guys. So obviously, when these are big institutions, their accountability is much higher than two fund managers that have just come and made a presentation to you.
Yeah, and with these institutions, it's very difficult to move your own money. And with this kind of custodian agreement, it is nearly impossible. I think essentially there is no fraud in the system. That kind of roots out any kind of possibility of a fraud. That's where the custodian kind of comes in, and that's where the regulators in both US and India have ensured that this kind of system check and balance is there to root out the bad actors and root out the fraud.
Great. Thank you both, Saurabh and Nitin. I think, and to just summarize, as I understand, all these regulations are ensuring these checks and balances. The more the intermediaries, like in terms of fund managers or custodians, and then so on, the banks, it just makes sure like the it's the best interest of the investor to secure their funds and assets, which only I think brings in more trust and credibility to the whole system. So we will summarize some of these, important points in a blast post, which will be sent through email after the webinar, and we'll also be we are recording anyway, and we will be sharing that soon too. Feel free to ask more questions. Keep the dialogue open. So I'm putting this link for the Aravali Fund that we are launching on the iNRI platform. So make sure to use the contact form or reach out directly, and then we can connect you with Saurabh and Nitin over email. If you need more details in terms of the private placement memorandum, and then more details into the financials or performance or anything that you would like to ask, use this form and then connect with us. And
Uh,
thank you for that. Yeah. Yes.
thanks, Hemant, for giving us the
Thank you,
opportunity.
Evan.
Yeah,
Yeah.
Thank you,
So
everyone.
I
and
hope you
thanks
had a
everyone for joining on the Sunday afternoon.
yes. I hope everyone had a great time. A lot of people I think stayed over, which only speaks of the interest and the enthusiasm they have to learn more about this topic. And thank you, Saurabh, again, and Nitin for taking the time, especially Nitin, who's I know must be late night there. Yeah.
Thanks so much, Hemant. Thank you.
Thank you, everyone.
Thank you. Thank
Thank
you,
you.
everyone. Have a good one.